Please note, this session is closed to the press. The views and strategies described herein may not be suitable for all clients and are subject to investment risks. Certain opinions, estimates, investment strategies, and views expressed in this document constitute our judgment based on current market conditions and are subject to change without notice. This material should not be regarded as research or as a JPMorgan research report. The information contained herein should not be relied upon in isolation for the purpose of making an investment decision. More complete information is available, including product profiles, which discuss risks, benefits, liquidity, and other matters of interest. For more information on any of the investment ideas and products illustrated herein, please contact your JPMorgan representative. Investing involves market risk, including possible loss of principal, and there is no guarantee that investment objectives will be achieved. Past performance is not a guarantee of future results. This discussion is for informational purposes only. The speaker's opinions belong to them and may differ from opinions of JPMorgan Securities LLC and its affiliates. Views presented on this webcast are those of the speakers. They are as of July 10th, 2025, and they may not materialize. This is not an investment research call and is not personal investment advice or solicitation or recommendation. Investment products are not bank deposit products, which means they are not guaranteed by a bank, not FDIC insured, and have risks, like the possibility of losing money on your investment. JPMorgan Chase & Company and its affiliates do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only and is not intended to provide and shall not be relied on for tax, legal, or accounting advice. You should consult your personal tax, legal, and accounting advisors for advice before engaging in any transaction. Asset allocation/diversification does not guarantee a profit or protect against a loss. The webcast may now begin.
Hello, my name is Elise Ossenbaugh, and I lead investment strategy for JPMorgan Wealth Management. I am very pleased to welcome you to this one big, beautiful webcast where we're going to be diving in to some of the planning considerations and also the potential impacts to our market and economic outlook stemming from the tax and spending legislation that was signed into law by the President on the 4th of July. Whether you're joining us for the first time or following up from the webcast we did in mid-June, back when this one big, beautiful bill was making its way through Congress, we're very eager to share our insights with you and also field some of your questions once we get to that Q&A portion at the end of this call. Before then, though, you are going to hear insights from two of my very esteemed JPMorgan Wealth Management colleagues. Joining us today, we have Sarah Daya, who is our Central Division Lead for JPMorgan Wealth Management's Wealth Planning and Advice team, and my fellow global investment strategist, Vinny Amaru. Now, I would love to take the opportunity to give you a chance to introduce yourselves for those in our audience who perhaps aren't familiar with you. So, Sarah, let's start off with a little bit about your background.
Great. Thanks, Elise. Good afternoon, everyone. Thank you for being here with us today. Like Elise said, I'm Sarah Daya. I lead our Wealth Planning and Advice team for the Central Division. I really focus on our team's planning content, so estate planning, tax planning, liquidity events, and really bringing that content to life by having conversations with you all and your advisors on all of these topics. I think one place where I add a lot of value is in the tax area, because prior to joining JPMorgan, I spent about 12 years of my career at the IRS as a tax attorney, was there for Tax Cuts and Jobs Act and CARES Act, and it's great to be here today to talk with you all about the tax changes that we're seeing under the One Big Beautiful Bill Act.
Very grateful to have you on board.
Thank you.
And Vinny?
Yeah, hi, everyone. Good afternoon. My name is Vinny Amaru. I am, as Elise mentioned, a global investment strategist here in JPMorgan Wealth Management, really helping clients understand our macro and investment views. I actually started my career with Elise, around 10 years ago at JPMorgan. Spent around 5 years at JPMorgan, left to get my master's degree because I really love talking to clients about our investment outlook, our macro outlook, wanted to do a master's in comparative political economy. Did that, and then spent some time at both UBS and Bridgewater Associates, really working on investment strategy, and rejoined JPMorgan back in December. So very happy to be back and to be up here with both of you.
Wonderful. Well, with the introductions having been made, let's get to it, because there is a lot to cover. Sarah, I'm so grateful that you're joining us, especially with the background that you have, to really help us start to break down this legislation, because there's definitely a reason that the word big is in the name of the bill because it definitely covers a lot. So why don't we start off with just highlighting a few of the key provisions that are perhaps the most broadly applicable to our audience?
Yeah, I think that's a great place to start. And there are so many provisions in here that I put together a slide. So if we can pull that slide up for our viewers to see. This is kind of these are some of the broader provisions that I think are going to be impactful to a lot of you. I'm really going to start in the middle of this slide with just going through what's been extended. And here, right, really not very many surprises because most of these are extensions of what we had seen in Tax Cuts and Jobs Act. So we've got the income tax rates that have permanently been extended at 37% as that top rate. For the estate and gift tax provisions, we have an increase to $15 million in terms of lifetime exemption per person as of January 1, 2026. That'll go from where we're at 13.99 today. That's also permanent. That amount gets adjusted for inflation every year. One of the things that was highly talked about, during the negotiation process was the SALT tax deduction, right? The state and local taxes. And so for those of you in our high state jurisdictions like California and New York, there is some relief. The SALT deduction increases to $40,000 for tax years 2025 to 2029. That $40,000 amount does have a phase down, though, for households making more than $500,000 and high income earners making more than $600,000. And that will go down to what the current cap is of $10,000. The AMT limits are permanently extended. The mortgage interest deductibility amount is going to stay at $750. That also was a permanent extension. For those of you who are business owners and maybe have pass-through entities, the qualified business income deduction is permanently extended at the 20%. Bonus depreciation and R&D expensing have come back in at that 100% amount. And then we also do have an extension of the debt ceiling by $5 trillion. And so those are the things that have been extended. And like I said, that's probably the easier part. Next, I want to kind of walk us through what was cut, right? Like Elise said, we were here a couple weeks ago and really talk through what the House has passed, and there was a lot of conversations around that. Some of those provisions did not make it into the final bill.
Right.
Some of them, made it in, but they were changed. And so under what's been cut, a big one is the energy tax credits. So the bill that was passed does scale back a lot of the Biden-era energy tax credits that we saw come through in the Inflation Reduction Act. So the EV tax credits have been repealed, and then some of the others that were part of the IRA are going to be phased down incrementally over the next couple of years. Related to private foundations, the House's original proposition was to increase taxes on private foundations. I think the limit was up to 10%. That went away, so we're still at that 1.9% that we have seen. The other big one that we had talked about last time that really was negotiated here was this idea of the revenge tax. That also did not make it into the final version of the bill. And then in terms of the actual cuts, we do see in the final bill Medicaid reductions. So the bill does cut Medicaid federal support by about $930 billion through 2034. And adds in a work requirement for some able-bodied individuals, and then the Supplemental Nutrition Assistance Program, the SNAP limits, that the bill does cut federal funding for SNAP provisions. What's new? And this is kind of where I think, again, this is a big, beautiful bill for a reason, right? Yes. So we've got a lot here. So there are some taxpayer-friendly provisions that kind of come in. So the big one that was really talked about on the campaign trail was no taxes on tips and overtime. And so we do see that coming in the big bill, that it does eliminate federal income tax on tip wages and allows individuals to deduct a certain amount of overtime wages from their taxes. Now, this is only through 2028, so it is one of those provisions that is not permanent. There are also limitations on it. So for tip income, the deduction is $25,000, and that starts to phase out at income of $150,000 for individuals who are filing as single and at $300,000 for individuals who are married filing jointly. For overtime wages, the deduction is $12,500 for individuals filing as single taxpayers, and it's $25,000 for individuals who are married filing jointly, subject to the same phase out that I mentioned for tips, with the $150,000 for singles and $300,000 of adjusted gross income for individuals. I think the other big add here is the auto loan deduction, right? I think that's one that we are going to hear a lot about. So for those of you who are thinking about buying a new car this year, there is an auto loan deduction up to $10,000 on qualifying car loans. Keep in mind that the purchase has to be made between 2025 and 2028, and it is for new vehicles only, right? So, and the final production or the final assembly of the vehicle has to be in the United States. I think there's going to be a lot of discussion in terms of how do we figure out whether final assembly has been made in the U.S. or not, and I think we will be relying a lot on our auto dealerships to provide some of that information to us. This also is subject to a phase out, and the deduction does go away completely if you've got modified adjusted gross income of $149,000 if you're single, or $249,000 if you're married filing jointly. And then the last couple that I want to highlight are, changes to itemized deductions, changes to qualified small business stocks. So again, for any of our business owners out there, that's going to be impactful to you. And then there are opportunity zones that are coming back into play in 2027. And these are really just the highlights. There is a lot more that's in the bill that I think over the next few months, as we start to digest it, will come out.
Certainly. Well, at the very least, I'm very grateful that you put together kind of this snapshot overview, because I think it is really helpful. And one of my takeaways here is that these are really good things to be aware of, but a lot of them are just things that you want to be mindful of when it comes to filing your taxes in the next tax season, right? I'm curious, though, for the folks on the line who are listening and wondering if there's anything that they should be doing right now as a result of this legislation, whether there's something you would flag as particularly urgent in terms of action items.
I think that there are two things that I would probably say we want to think about as being urgent. One is related to charitable giving. And so if any of you are charitably inclined and you regularly give to charity, the one thing to keep in mind is the bill does introduce a floor in terms of the deduction for charitable giving. So there is a 0.5% floor before you're able to deduct your charitable giving on your tax return starting January 1, 2026. And so if we're thinking about making large charitable gifts, it may be a better solution to do it in 2025 and sort of front load your charitable giving, because that deduction will be worth more than it probably will be in 2026. And then the other thing that I think is imperative to start thinking about right now, really for our business owner clients, is thinking about the structuring of how the business itself is structured.
Yes.
Because like I said, there are some qualified small business stock provisions that change. And so if we need to make decisions where we're converting from, let's say, an LLC to a C Corp to take advantage of some of those things, the sooner we do that, the better.
Certainly. And this is a point where I just want to call out, I think, the opportunity to reach out to your JPMorgan Wealth Management advisor and collaborate with them on some of these considerations. Because for those people who may be charitably inclined and feel like they want to give but are unsure of how much they may be able to give, that is something that we can incorporate into your wealth plan and really help make part of that holistic kind of financial journey that we collaborate with you on. So super helpful in thinking through some of those urgent action items, whether you're an individual or a business owner. But I would also love to touch on some of the things that maybe should be on our radars, even if it's a goal or an event that might not happen for another 5 to 10 years. Anything in the One Big Beautiful Bill that we should keep in mind as we think about those longer term goals?
I think as we're thinking about longer term goals, a couple things that jump out is education planning is one that jumps out, because one of the things that the Big Beautiful Bill does do is it caps the ability for students to borrow.
Yes.
And so if we've got, if we're parents and we've got kids who maybe are thinking about going to law school or medical school, maybe we need to build in more goals about how is that schooling going to be funded, and is it going to be something that, as parents, we're going to be providing that support, and how is that going to impact your plan? The other thing is going to be, on that same lens is, if we've got elderly parents or elderly family members who maybe have been getting some Medicaid funding, and if there may be some risk of that being cut, and we need to support our family members, How is that going to impact the plan? And then, overall wealth transfer strategies, just starting to think about those. The estate and gift tax exemption has become very generous now at $15 million per person, but there's still going to be opportunities, at least longer term, if we've got liquidity events happening, with a business, for example, or asset prices continue to go up. I think that wealth transfer piece is also going to be really important to consider over the next, let's say, 3, 5, 10 years.
Perfect. So plenty of things to consider on an individual level. And I think this sort of micro perspective is really, really helpful as just kind of a starting point. This is where I want to pull Vinny into the conversation to start thinking through the macro implications. Obviously, as Sarah mentioned, there is a lot in this bill. Some of it is just a continuation of the environment that we've been in, but to her point, there are elements that are new or maybe shifting the landscape a little bit. So where I would love to start, Vinny, is with the overview of how this might impact our economic outlook over the course of the next year or so.
Yeah, sure. I think it's first important to start, what's the point of brand new fiscal policy, right? Because to me, the goal is you want to stimulate the economy. You want it to grow faster than it was before. And that type of stimulus can come in a lot of different ways, right? You can have tax cuts to households. It can be tax cuts to corporations. It can be direct payments to consumers like we saw during COVID. It could be subsidies for certain sectors. And so there are a lot of different ways to stimulate economic activity. But to Sarah's point in the beginning, I love that slide because what we're really interested in from an economic perspective is what's net new, right? It's what is the difference between what is going to be basically spent by the government or that really loss in government revenue. How is that going to be different than where we are today, right? So starting from today, what is net new? And so when we look at the bill, we do see that net new impact really concentrated in those first 3 to 4 years of the bill. Sarah mentioned it, like the no tax on tips, the no tax on overtime, the auto loan deduction. All of those are really heavily front-loaded in that 2026, 2027, and 2028 period. And so that is where we think that we're going to see the thrust of that type of economic impact. And again, the cuts are a bit more lagged. So some of the Medicaid work requirements a bit further pushed out. So that net new, we're really focused on the next few years. When we think about both the business incentives and some of those programs that we just talked about, we do think that you could get a small impulse in terms of economic growth coming from the bill in 2026. But the thing is, fiscal policy is not just the bill, right? And we have to really factor in that tariff drag. When we think about tariffs mostly being a tax on U.S. businesses and U.S. consumers, we're trying to net out the two. And so while we do think that the big, beautiful bill can add a bit of fiscal impulse next year, we do think that that tariff drag will mitigate some of that impulse. So maybe a few percentage points next year, but it doesn't really move the needle in terms of near-term growth. But I think it's important to mention that those business incentives, a lot of them, some of them being permanently extended, certainly could lead to growth as you think about that longer-term time frame. And so I don't want to discount that.
I think that makes a lot of sense. And what you flagged in terms of not thinking about this in a silo, really, really useful to remember. Since you brought up tariffs, I do want to go there because obviously it's been the dominant theme of 2025. Tariff news is very much back in the headlines this week. Before I ask you more questions about how that's driving our outlook, can you just give our audience kind of a recap of where we've been on this tariff journey so far year to date?
Yes, I will do my best to do this in a quick manner. But I think, again, starting with the goal, right? I think it's going to inform a lot of the way that we talk about tariffs in general. The stated goals from the administration, we want to incentivize manufacturing in the U.S., makes imports a little bit more expensive via tariffs. And 2 is to raise revenue, right? And somewhat offset some of the cost of the one big, beautiful bill. And so with that in mind, let's take a journey through the beginning, so far this year. We start the year with an effective tariff rate around 3%, so pretty low by historical standards, where it had roughly been, for the past decade or so. And, we have some of these announcements coming out in February and March with Canada and Mexico, but April 2nd, Liberation Day, that's really where we see that really first big impulse from the tariff side. And so with all of the tariff rates that were announced at that point. It really took the effective tariff rate to something close to 25%.
Right. Big shock for markets.
Big shock for markets. And so a week later, you have April 9th, you get a 90-day pause, right, on most countries. And it's basically a 10% baseline tariff, higher on China. We have that negotiation going on all throughout April. But you also get a reduction in tariff rates and a pause in May. And so we start to approach our 90-day extension July 9th. But this past weekend, President Trump decided that, you know what, we're going to push that deadline out to August 1st.
Right.
But we need to have further negotiations.
Yes.
And so what you've seen come out so far are just higher tariff rates really announced on certain countries. Yesterday was a 50% potential tariff rate on Brazil on August 1st. So you're seeing that negotiation play back and forth, but hopefully that brings us up to where we are today in terms of the timeline.
It does. And I think my big takeaway is that this is still very much in motion, right? There's still an element of uncertainty here, but our job as strategists is to come up with a view and assess how the tariffs and where they end up ultimately is going to feed through and have investment implications for our clients. So taking our expectations for tariffs and where they're going to kind of settle out, put that in the context of the outlook.
Yeah, so I think the fun part is that we can track this on really a monthly basis, right? We get the import data every month, and we can also see how much we're collecting in tariff revenue. And so every single month throughout this entire process, we've been tracking, well, what is the really effective tariff rate, that average tariff rate across all countries? And we think it's creeping up, right? We think it's around 8 to 9% right now.
Sure.
We think it's going to go higher, right? We think it's going to be in that 10 to 15% range. And I think the most important thing that I want to highlight is we think it's going to stay there, right? And getting back to the goal that I said at the outset, raising revenue, right? If you want to raise revenue, you need to keep those tariff rates higher. And so we think it's going to end up in the 10 to 15% range, and that's really what we're anchoring our macro outlook on. But again, we think that this is a good time where markets are generally looking through a lot of the tariff noise, and it's one of those times where if you can revisit existing allocations, using this sort of calm in the market potentially before you could see a bout of volatility, could be useful.
Makes sense. So, okay, we've covered the economic implications of the One Big Beautiful Bill. Your expectation is that in 2026 and maybe for a couple of years thereafter, it could offer a positive growth impulse to the economy, but you also have these multifaceted impacts stemming from tariff policy that could potentially offer a degree of offset. That's kind of my summary, but I would love to hear it from you. Just the quick overview of how all of these pieces fit together in our outlook. What's the punchline here?
Yeah. So again, back to frameworks. I love these, but the framework that we've been using this entire year is that you have these shocks and shock absorbers, right? Tariffs are a shock, but we have really strong shock absorbers in the U.S. economy, right? Consumers and businesses starting from a very healthy place. And so when we've taken all of these things into account, at least for 2025, we do think that growth slows from that 2% that we were expecting at the beginning of the year to something closer to 1%.
Sure.
But not a recession, right? It's because you have those durable shock absorbers in the economy. We've started to see some slowing in the labor market, especially when it comes to continuing jobless claims.
Yes.
Which really gets to the point that if people lose their jobs, they're having a bit of a difficult time finding another one. But it's consistent with our outlook that growth is likely to slow over the course of this year, but not a recession. On the inflation side, we do expect that inflation will move a little bit higher. So from our expectation where we thought that we would end the year at 2%, maybe a little closer to 3%. Of course, we just haven't seen much of a tariff impact thus far. There are a few reasons that we can highlight. One is just the front running of imports ahead of tariffs, so a little bit of a cushion there. Again, shock absorber. Then you can also think about, well, it takes a long time for those goods to get from where they're coming from to the United States. And so you might have somewhat of a delay by the time they hit customs. Those tariffs end up getting paid. And then businesses want to pass them on to consumer. But also the idea that you could be in a very competitive industry. Sure. Right? And you don't want to be the first mover to pass on those costs because you might lose market share. And so there may be some sort of delay there. But I guess the punchline there is we do still expect for inflation to move higher in the second half of the year.
Okay, so slowing economic growth, pick up in inflation, but the confluence of these things we don't think is going to characterize a recession. You also mentioned maybe the tough decisions that businesses could have as these tariffs really start to hit their own bottom lines. Are they going to pass on those increased costs to consumers? Are they going to absorb it and maybe take a hit to their profit margins? And that leads me to the question of what this really means for investors. How can we feel confident continuing to invest when the U.S. stock market, as measured by the S&P 500, is at all-time highs, despite this uncertainty and despite this ostensible kind of slowdown in the macro backdrop?
Yeah, we think that even with markets at all-time highs, we do still see further upside, in the broad equity market. But we really want to be selective and focus on the areas where we have the highest conviction. And that's going to be in the broadening out and buildup of the AI ecosystem and financials. Like just two to highlight. I mean, the AI ecosystem, we can see that, like that CapEx just continuing from, the hyperscalers to the power generation. I feel like I was thinking about like the Jaws analogy of like, we're going to need a bigger boat.
Yes.
But it seems like, we're going to need a bigger build out, right, of the AI infrastructure, because you can see that adoption is just, it's picking up. Like adoption measured by the Census Bureau has doubled over the past 12 months, but that's only at 12%. And so when you think about adoption broadening out, if we're starting at 12%, you can only imagine like where we expect that to go, which is higher, that you're going to need more power, more data centers, more semiconductors, really every single part of that ecosystem to be built out. And getting back to some of the business deductions really could be beneficial, right? The 100% accelerated depreciation, this idea of, again, being compensated for building in the U.S. could really accelerate that trend when it comes to finding opportunities across that ecosystem. Touching quickly again on financials, getting more to like that deregulation theme is, look, we think that deregulation can impact financials in a really positive way by unlocking excess capital. And we think that excess capital on bank balance sheets can be deployed in a shareholder-friendly way, which could lead to M&A. It could lead to buybacks. It could lead to further loan growth. So we think that is, kind of what can drive the market higher. It also doesn't hurt that those happen to be the two biggest sectors in the S&P 500. And so you can see like why when we're positive on those sectors, we can also be positive on the broader market.
Love it. So what I'm getting is there are opportunities still to be found within the equity market, but we want to be thinking a little more thematically and maybe focusing on those trends that could kind of power through regardless of what macro environment we find ourselves in over the course of the next 12 to 24 months. I do think it's important to acknowledge that even despite that relatively optimistic or constructive outlook for equities from here, it's really important to also have shock absorbers in your own portfolio, be it core fixed income or the consideration of additional assets, maybe like an allocation to gold. Either way, what we think those assets can help do is navigate volatility if and when it does arise in your portfolio, because 2025 is far from over. As you both have highlighted, there are still these elements of uncertainty at play. Sarah, just before we open it up for Q&A, because we are fast approaching that section of our webcast, I want to come back to you really quickly on the topic of volatility. Because in the spring, when this was front and center for investors, we were also encouraging folks to consider some of those opportunistic ways to maybe advance towards some of their financial goals by taking action on the planning side. So if we were to see a pickup in kind of market choppiness, what are some of those things that maybe should be on people's radars as action items to consider?
Yeah, I think volatility presents us with unique opportunities with that planning lens, right? I think the biggest strategies that we talk about when we're thinking about planning for volatility is looking at your balance sheet and seeing, is there an opportunity to do something like a Roth conversion, right? Because the idea is we want to convert some of those traditional IRA assets while asset prices are depressed, so that whenever that bounce back happens, it happens in that tax advantaged account of that Roth IRA. The other opportunity that we really see is the opportunity to harvest losses. I don't know that we've seen really over the last couple of years very many opportunities, but I think with volatility, we had some really good opportunities to do some tax loss harvesting and being able to capture those losses to apply against any future capital gain transactions that we would have, whether that's going to be the sale of a business, whether it's going to be the sale of real estate. So I think those are the two top ideas right now. It's really thinking about, is there an opportunity to convert to a Roth so that we capture that bounce back in a more tax-advantaged account?
Sure.
And if we think that we're going to have a capital gain realization event here either this year, next year, or in the future, do we have the opportunity to bank some of those losses that we can then use to offset some of those capital gains taxes?
Well, and by the way, that just seems like good hygiene and kind of something that you should be doing on a regular basis. Anyways, I know it's a big focus area for a lot of our advisors here at JP Morgan Wealth Management, and something we certainly have the tools and capabilities to help with. So at this point, we are moving on to the Q&A portion of the call. So if there's something on your mind that you want us to answer right here, please don't be shy about submitting those questions into the box that you see there on your video browser. Starting off with some of the ones that we've seen come in so far, Vinny, the first one's going to be for you, because what we got a question on was the debt or deficit impact of the new One Big Beautiful Bill. Any thoughts there? How are we thinking about this, into the future, given that it has been a conversation investors have been having in 2025?
Yeah, it's a great question, because I think it also brings back the conversation that we were having, which is that fiscal policy in aggregate is both the bill, which is additional spending and a revenue cut from tax cuts, but also tariffs, which are a revenue generator. And so we have to net those two together, right? And what we expect is that you can see a situation where, yes, the bill could add to the deficit, which we know will happen, but it could be offset by those tariff revenues to make it almost not as fiscally expansive as they would have otherwise been. And I honestly think that offset is really one of the reasons why the bond market in the U.S. has just taken this in stride, more so than I think you would have imagined had you not had this revenue offset.
Yeah. And to be clear, I also don't think it's market complacency, because there was volatility in the spring as people were kind of working through this and considering what the debt and deficit impact of all of these policy changes might be. But to your point, now that we have the information in hand and we can kind of put pen to paper, it seems like nerves have calmed down a little bit.
Yeah, and it's certainly one of the reasons why, look, it comes up a lot, and it totally makes. I was actually having a conversation with my dad about this last night, but this is why when we're talking to both all of our clients, it is thinking about if you were to see that risk materialize, what are, again, those shock absorbers that you can add to the portfolio, why we've been talking about having that international exposure in portfolios, why we've talked about having gold as a diversifier in portfolios. And so again, it gets back to, identify the shocks, identify what shock absorbers are at your disposal, and how do you, put them together.
Great. All right, Sarah, next one's coming for you. One of our listeners noted that we haven't addressed these new Trump accounts that were introduced as part of One Big Beautiful Bill. So what are they, I guess, from a starting point, and should we be thinking about them in the context of financial planning?
Yeah, so the Trump accounts, right, it's really being used as a mechanism for saving for children. And so, under the bill, parents have the ability to do up to $5,000 into an account for their children that will grow tax-free until they hit the age of 18. And then it basically converts into something similar to a traditional 401k, right? Traditional IRA. The idea there is it's another account that's meant to help parents save for their children and to really start the kids off with some level of financial assets, as they continue to get older. I think that we really should, when we think about the financial planning side of it, I think we really should look at the Trump accounts in a broader way and sort of have a broader conversation around saving for children, whether that be saving for education or whether it be, helping the kids who maybe are working start off with retirement accounts. I think those Trump accounts sort of fit into that broader conversation about what's the best way that we can think about saving for children. Because, for example, right, if the goal that we're looking to save for is education, instead of putting money into a Trump account, it may be better suited to put those funds into something like a 529 account. And so it really comes down to what the goal is that we're looking to solve for, and then finding the right vehicle for purposes of being tax efficient and making sure that we're earmarking it in the best way possible.
Perfect. Okay, Vinny, another one for you. Someone is wondering how we're thinking about immigration policy in the context of the economic outlook.
Yeah, again, it's a big part of the bill, right? It does add additional funding for basically ICE. This is the way we're thinking about it. A lot of things to still be determined. But what I'd like to do is, again, take it back to a framework. Immigration, very important part of the labor force growth in the United States. growth in the US, you can almost like separate into two very broad categories, which is labor force growth plus your productivity growth.
Sure.
Right? And that's going to get you to basically the growth rate of the US economy over long periods of time. When we think about that, if you reduce immigration significantly, it could weigh on your labor force growth. And we know that immigration and this idea generation that comes from a melting pot, could weigh on productivity growth. And so we think longer term, to the extent that, the immigration is curtailed dramatically for a very long period of time, you could see that growth rate of the United States economy, potentially fall. But again, like in the near term, we're still working through the implications, most likely like a slight negative on growth.
Awesome. All right, with an eye on the clock, I'm going to start winding this call down. But before we conclude, I want to give both of you an opportunity to share final thoughts. Sarah, why don't we start with you?
Yeah, I think, when my final thoughts would be that anytime we have a life event or we've got tax legislation like we do with the One Big Beautiful Bill, it's a good opportunity to reevaluate your financial plan and take a look to see, are we still on track to meet your goals? I think with the One Big Beautiful Bill, there's always this urge that we have to act on some of these tax changes today for 2025. And while that may be the case for some of our clients, I think more broadly, we want to think about how the tax changes are going to impact you, not just in the 2025 tax year, but in 2026 and beyond. Mm-hmm. I think it's also an opportunity for us to be a little bit more efficient with some of the things that we're thinking about. So whether that's how you're doing your charitable giving and being a little bit more efficient and thoughtful with that, whether it's, how your business is structured and thinking about whether or not there's a different way that would be better suited for what your goals are. This really just gives us an opportunity to come back to the table, to sit down with our advisors and reevaluate that financial plan to ensure that we're still on track to meet all of our goals.
Well said. Vinny, final thoughts?
Yeah, first of all, thank you all for joining today. I would say that I would love to give my final thoughts in almost like a near term, a long term, and one of the risks that we're monitoring when it comes to the Big Beautiful Bill. The near term, right? The idea is that we're going to see a little bit of a fiscal impulse, like to growth, we think next year. But again, we have to keep in mind like how that lever is almost being mitigated by the drag still coming from tariffs. Mm-hmm. And so small positive from the bill, but again, doesn't really necessarily move the needle too much. In the near term, I would say longer term, a lot of these business provisions when it comes to the 100% depreciation, like those are meaningful. And like they could certainly lead to broader growth over the longer horizon. And I would say, like, Sarah mentioned it, one of the things that we're watching is from a risk perspective, at least from the One Big Beautiful Bill, are the curtailments in spending for Medicaid and SNAP programs, how those start to play out in the coming years, as well as immigration. So just leave it there in terms of how we're monitoring the impacts of the bill going forward.
Great. And just following on that, I think if you are curious to explore the investment considerations that we've been talking to our clients with, I'm keen to encourage you to go to either chase.com/theknow or jpmorgan.com/perspectives to revisit our 2025 mid-year outlook, because we continue to feel confident that from a macro and investments perspective, the things that we said in that piece continue to ring true from our perspective. Sarah, as for key takeaways from everything you shared today, I think the biggest bottom line is to make sure to follow up with your JP Morgan Wealth Management advisor to really start to think through how these different changes might fit into your own financial plan. We are ready, willing, and able to help, and we are very grateful for your time today. Thank you so much for joining, and have a wonderful week.
If you are considering any investment or strategy, you should always do your research before making any investment decisions. Investment products are not bank deposit products, which means they are not guaranteed by a bank, not FDIC insured, and have risks, like the possibility of losing money on your investment. The S&P 500 index is an unmanaged broad-based index that is used as representation of the U.S. stock market. It includes 500 widely held common stocks. Total return figures reflect the reinvestment of dividends. S&P 500 is a trademark of Standard & Poor's Corporation. The price of equity securities may rise or fall due to the changes in the broad market or changes in a company's financial condition, sometimes rapidly or unpredictably. Equity securities are subject to stock market risk, meaning that the stock prices in general may decline over short or extended periods of time. Investments in commodities may have greater volatility than investments in traditional securities, particularly if the instruments involve leverage. Diversification and asset allocation does not ensure profit or protect against loss. JP Morgan Wealth Management is a business of JP Morgan Chase & Company, which offers investment products and services through JP Morgan Securities, LLC, JPMS, a registered broker-dealer and investment advisor, member FINRA and SIPC. Insurance products are made available through Chase Insurance Agency Incorporated, CIA, a licensed insurance agency doing business as Chase Insurance Agency and Services Incorporated in Florida. Certain custody and other services are provided by JP Morgan Chase Bank N.A., JPMCB. JPMS, CIA, and JPMCB are affiliated companies under the common control of JP Morgan Chase & Company. Products are not available in all states. Copyright 2025, JP Morgan Chase & Company. All rights reserved.